I'm not trying to scare anybody, but if you've got more than 20% of your investment portfolio in your company stock, you are taking a severe risk.
Welcome to Upticks with Jake Falcon, founder and CEO of Falcon Wealth Advisors. In this podcast, we help high net worth individuals overcome financial complexities. We do this by enhancing financial literacy and discussing topics in a language free from industry jargon. Now, on to the show.
Welcome back to Upticks with Jake and Cory. Cory, welcome back to the show.
Jake, thank you for having me back.
Cory, we've got a powerful topic today. We're talking about RSUs, also known as restricted stock units, employee stock purchase plans, and stock options. Should you keep them, sell them, or convert them? Cory, have you ever talked about this with a client?
Yes, I have many times, and I probably will for the rest of my life. People recognize it's good to have that company stock in their financial plan, but people don't always have a plan for it.
Yeah. So I want to get right into the topic today, Cory, of course. But a quick teaser: we also are going to talk about credit card points at the end of today's episode. So if you've got questions about credit card points, be sure to tune into the. Don't fast forward through our show. Stick around.
Don't miss all the good stuff.
Yeah, you're going to miss all the good. So stick around, Cory. We're going to talk about credit card points at the end of today's show. But here's the deal. Let me set up the framework of what we want to talk about. So you may be watching or listening to Upticks right now, and you could be sitting on a pile of company stock and wondering, is now the time to cash it out, or do I hold on for more? And I don't know where the stat came from, Cory, so I can't check the validity. I didn't check the validity of it. I guess I could, but I didn't. But the stat thrown at me said that 70% of corporate employees don't have a clear plan for their RSUs, ESPPs, or options. Cory, do you agree with this stat?
Yeah, I do. I think it might be 71%, Jake.
Well, here's the deal.
No, I do.
Here's my experience. So again, quick reminder, I've been a wealth advisor for 19 years. I've had thousands and thousands and thousands of meetings with corporate executives to talk about their restricted stock units, their employee stock purchase plans, and their company stock options. And I see one of two things typically, Cory, and I want to hear your thoughts on this. Either one, somebody has no plan for them at all. They know they have them. They may understand the intricacies of how the benefit works, and they may not, but that's it. No plan at all. Or the other thing I've seen a lot of, Cory, is that people say, yeah, we just cash those in and use them for vacations, or I use them for my kids' college, or I throw money at our mortgage, but there's not really a plan. So there's a somewhat of a strategy, but it's not really ironed out. It's just like, yeah, we use those for a variety of things. So they're not really wasting them, but they don't really have a plan, a clear plan for them. Is that your experience? Or did I miss anything?
No, it's generally one of those two. I don't think so.
All right, look at me, Cory. So here's the challenge. Here's the challenge. Okay. Good. So here's the deal. I get it. If you're watching this show, if you're an audience member, you've worked hard, you've earned equity. And for many people, you're getting close to retirement. Now, maybe you're a year away, maybe you're 10 years or 20 years away, but retirement is somewhere on that horizon. But the question is, what is the smartest move with these benefits, with your company stock? And some of the biggest pain points that we run into, Cory, that I want to unpack with you right now is, and I'll go over all of them, and then I want to we'll recap them real quick. So taxes. People don't understand the taxability of their different options, so they don't do anything. Stock market volatility, right? Is the company stock down, up, sideways, wherever? Is there emotional ties to the company stock, right? They're drinking the company Kool-Aid and they want to be a good brand ambassador, Cory, so they don't want to sell their company stock. Or FOMO. What's FOMO, Cory?
Fear of missing out.
Fear of missing out, right? Well, is the stock going to split? Is it going to double? Is it going to increase its dividend, right? Are they going to merge? FOMO, right? They don't want to miss out. So let's go back real quick to the challenge of taxes, Cory. What do you say to clients when they're worried about taxes on this specific, the restricted stock units or employee stock, and et cetera?
Well, one, we should go through our tax planning process. How does all of this fit into your financial plan? But two, recognize that if you are paying taxes, that it means that you made money, which is not a bad thing. And you need to figure out how all of it does fit inside your plan.
Right. Good, Cory. Yeah. So to unwrap that tax process, so what we actually do is we take each and every one of your grants, we build that into your financial plan. We take the cost basis And then our financial planners will model that out, and they'll be able to tell you projected tax implications based on selling, holding, whatever. So you're right, Cory. That's where it's got to start before we give you any advice. And again, we're not CPAs. Full disclosure here for compliance. We're not looking to replace tax advice here. That should always be done by your CPA. But we can run projections and give you some rough estimates so that you can make good planning decisions. And like you mentioned, Cory, taxes are not a bad thing necessarily. If you're paying taxes, it's because you made money. People that don't make money don't pay taxes.
Also
people
correct.
that make money pay taxes. I like to be the side that makes money, Cory. I don't know about you.
That's right.
All right. What about market volatility, Cory?
Yeah, this is a big one, Jake, because I have my experience, again, like you've done this 19 years, Jake. I've done it 15. I've seen clients that their feelings about their company stock sort of blows in the direction of what direction the stock is actually going, like how they feel about it. Like there's times where it's down and it's like, I can't wait till I get rid of this. Company stock's doing great. And it's like, I'm so glad that I own a bunch of this. Right. And that's all emotion. That's not planning.
Right. So again, that's why you've got to have a plan, because you're right. Especially if you've got a lot of money in one stock,
yes,
more than likely it's going to be very volatile and it's very risky. And so I'm not trying to scare anybody, but if you've got more than 20% of your investment portfolio in your company stock, you are taking a severe risk for you and your family that may work out greatly for you. And I've got clients that have done that, Cory. I've got clients that had 100%, right, for many, many years, and they did very well. And they know they were rolling the dice and it was risky. So again, just be careful with that market volatility. It is a challenge. The third one is the emotional attachment. I get it, especially if you love your company and maybe you're a vice president, right? Maybe you're high up on the food chain there. And so you don't want to be seen as a bad leader by selling your stock. But here's the bottom line, Cory. Even CEOs sell company stock. In fact, they have to file it. It's public information when an officer sells. And so you have to take care of yourself first, because sadly, the company's bigger than you. And in the end, if they have to let you go, they're going to let you go. That's just the way it works. That's the way corporate America works. I've worked with too many clients that were blindsided by that. And so you've got to take care of yourself first. In my opinion, the people that I see, and this is not advice, by the way, the people though, Cory, that I see that generally have the most company stock are actually the founders. Not even the CEO, because I respect CEOs because I'm sure it's a hard job, but I don't respect them as much as founders of the visionaries, like you and me, Cory. Like we founded Falcon Wealth Advisors. We own all our stock, and that should be rightfully so.
Correct.
And in fact, Cory, if you were trying to sell some of it right now, I would want to know why. Because right? I would like, what are you worried about? Like
exactly.
Maybe you had a valid
concern. Do I need to sell mine? No, I'm just kidding.
Maybe you had a valid concern. But the founders, I get it. But other than that, Cory, there should be no shame. In fact, again, even if a founder's selling, right, there should be no shame. But you need to understand. So again, don't get too emotionally tied up in your company. You can still be a great corporate citizen and drink the Kool-Aid without putting 50% of your liquid assets in the company stock. That's just very risky.
Yeah, that's right. So tell me, Jake, let me just ask you this question. I've done this for clients before. And as a challenge here, though, to actually put this into words, what you're talking about is, I've looked at clients. It's like, what if this concentrated stock position that you own goes down by 50%? What does that do to your financial plan in the rest of your life? And I think that's what can help paint the picture of you saying, look, if you have 20% or more in a concentrated position, particularly in your company stock, like that's the risk. And if people watch the markets at all, right, there's big moves, right? Companies can move 50+% any given year. And my experience is that people think, well, that happens to other companies, but not whatever XYZ stock that I own. And that's the thinking that you really want to be careful with. And that's why you've got a plan.
Yes, it can happen to any company. You're exactly right. I don't care who it is. You're right. All right, Cory, you're the young guest on my show today. So explain
You're older
FOMO.
Now, Jake. You're older.
Explain. Oh yeah, happy birthday. But anyways, explain FOMO, Cory. Explain FOMO to our audience.
The fear of missing out.
So what does this mean as it pertains to their stock?
It pertains to everybody else is making a bunch of money owning this stock. Shouldn't I own a bunch of it too? It's the feeling that you're getting left behind or that you're missing out. There was a famous New York Times headline, Jake, that I'm just going to point to real quick here from 2017. And the headline was, "Everyone is getting hilariously rich except for you." And I'll never forget seeing that, because like that is, if that's not speaking to FOMO, I don't know what is.
Yeah. So just be careful of that. Recognize that it's actually a problem. And in the end, money has utility, and it's about aligning it with your purpose and your plan. And that's it. Don't let your ego or FOMO or whatever, or emotions charge you up here. These are all big challenges. And again, this is why people hire us, Cory, at Falcon Wealth Advisors, so that we can help guide you through these challenges, help you with tax planning, help you understand market risk and volatility, detach your emotions from the company, right, as an unemotional third party, and then really talk you off that ledge of that FOMO. But here's the opportunity, Cory.
Let's hear it.
Here's the opportunity. With the right strategy, your company's stock can become a powerful part of your retirement plan, right? You can actually tax efficiently liquidate these and be very strategic about your taxability on these awards if you play it smart. And I don't like timing the market, but you can be strategic on when you liquidate and then ultimately diversify this award into something else that's more aligned with your financial plan. So that is the fun part about it. I don't know about you, Cory, but I love sitting down with a new client and they say they have RSUs. And it's not because it's like, oh, great, they have more money. Well, that's always nice, because I know that they're going to have more money than just their 401k, but it provides another layer of opportunity that we can build out their plan and provide value in their lives. And that's really what's happening, is that we build out this whole schedule on their restricted stock units or stock options. Not as many companies do stock options anymore. Did you know that, Cory?
I did.
Do you know why?
Why?
Do you have a guess?
I've got a guess.
Let's hear your guess.
I think with the stock options, it gives people they're granted shares, right? That you could exercise those grants, as opposed to the people that are receiving stock options can exercise those options versus RSUs. In my experience, this is just from what I've seen, Jake, there's more people that have RSUs as part of their annual compensation.
Do you know why though?
No, go ahead. Let me hear it.
Who's the owner of the LA Clippers? Ballmer. What's it? He was a CEO of Microsoft.
Steve Ballmer. Ballmer.
Yeah, I think you're right. Yeah.
Mm-hmm.
So I'm listening to a podcast, of course, Cory, with him on it. I didn't know this. Something has to do with, it hurts corporate earnings when corporations issue options versus RSUs, actually. So I believe Microsoft was one of the first companies to stop issuing. This is what he claims. I don't know how true he is, but he's pretty arrogant guy. Rightfully so. He's like a billionaire, right? Whatever. So
I don't know about rightfully, but yeah, go on.
Whatever. Yeah, we can go on another. So anyways, I think it actually hurts the company from a ledger, right? From a balance sheet perspective versus giving RSU. So that's actually why you don't see stock options as much.
Interesting.
This is what he claims. And I actually kind of agree with it, because frankly, Cory, with our clients, I don't see stock options nearly as much. I think stock options are probably more prevalent in the startup world, because the company doesn't have probably much value. So an RSU doesn't really make as much sense. So I think that's probably very prevalent. But I think in a more established company like a Microsoft, you're going to see RSUs. So anyways, my point though of that is that they can be a powerful part of your retirement plan if we talk about when to exercise your options or liquidate your RSUs, or when to buy employee stock purchase plans, and then being very tax efficient when you liquidate, and then ultimately realizing what are you going to diversify to. So that's the cool opportunity, and that's what I get excited about. And that's what our planners do, Cory, is they build out a whole schedule in the financial plan, and then we can start running what if analysis on all of it. We can run it on all of it, and we can even say, what if the stock doubles? What if it goes down by 50% or goes to zero? Like, what does that do to your plan? And so there's opportunity, there's control on a lot of this, and again, it's a very powerful part. And frankly, this isn't all clients, but it's almost like, you remember we have a lot of clients with pensions, Cory. I would argue this is like a new pension, where clients that have these types of benefits in their package, their financial plans typically, not always, can be in better shape, because again, there's not just a 401k. They've got other perks that they've been awarded throughout the years. Does that make sense?
It does. And I think, though, unlike the pension, right, and what you're talking about here today, Jake, and what we're talking about is that you need to have a plan for that. Like, it's that responsibility is on the individual, because it's not a pension plan. There's the RSUs, there's, the employee stock purchase plan, but it's on you to figure out as the individual. It's not just going to provide this guaranteed income stream the way an old defined pension benefit plan would.
Right. And you can't just ask your HR. Don't ask your HR department on what to do, by the way, either, because they're going to be very familiar with the rules, but not going to be able to tell you how to do all this. This is why you hire a wealth advisor group that specializes in working with corporate executives that's been through this before.
Let me ask you a question, Jake. Let's just let's play this out real quick. So you've met with lots of corporate executives in similar situations. I have too. But I'm coming in to meet with you, Jake, for the first time. We're in your office, and I have almost all of my money invested in my company stock. Maybe not all my money in my 401k, but I have a concentrated position. But I say, Jake, because I've had all this money concentrated in this company is the reason that I have so much money. What do you tell that person? What do you tell someone who says, I have all of this? The reason that I've accumulated this dollar amount is because I've concentrated in my company stock. And now, Jake, you're telling me to do something different. What do you tell them?
Yes. Well, first, I congratulate them for getting lucky. I tell them that. I'll say, look, that's fantastic. And I'm glad. Let's say they've got $5 million, just to throw out a number.
Good.
So, and they say, Jake, look, I've crunched the numbers. If I didn't do this, I'd only have 2 million. And now I've got 5 million. And I would say, congrats. I would consider yourself very fortunate and very lucky. And I would just challenge them and say, okay, what if that 5 million goes to 2 million though? Then what? Then what are we going to do? And clients know me very well, Cory, that I'm not a rip the Band-Aid kind of guy. So I will use very strategic. I'm not saying you have to, very rarely have I told someone they have to sell it all immediately. I don't know if I've ever told them that. First thing first, I empathize with what they've done. If they've succeeded, I congratulate them, but then I talk about, okay, now let's strategize how to de-risk your portfolio so that you can sustain this money. Because oftentimes, Cory, when people go from 5 to 10 million, I've seen it, their lifestyle actually doesn't change that much.
Mm-hmm.
But if you go from 5 to 2, it does change.
Yeah, it's true.
It does change. And so that's what I would say, look, I've been doing this for 19 years and I don't want to hear about you being one of those people that goes from 5 to 2. And I'm not trying to scare people, but I say, let's have a strategy so that we can protect this nest egg that you've built up, lucky or not. Let's keep this 5 million and let's turn it into 6 or 7 and lower that risk of it becoming 2. Again, there's no guarantees. There's no promises. I just know that, again, they're rolling the dice, and I would try to use some examples of that. And I've got one. Actually, that's a good segue into storytelling.
Please, I was going to ask you for a story.
Because I got a real-world story, and hopefully you do too. I've got one here. So here's a reason, not talking about market volatility, of why having all of your money in stock options or RSUs can bite you. And I've seen this happen. So I had many clients, Cory, that worked at a large publicly traded company. They got bought. And when this company got bought, all of their shares were liquidated. So they were forced to sell all of their stock. Now, granted, the stock price was valued at a premium, so they got more. So they didn't lose money. However, they lost their ability to control their taxes. And so what happened is this created significant tax issues for people because they weren't planning ahead of time for this. So again, it was a bit of a good problem, like we talk about with taxes, that they had to pay more taxes than they planned. However, if they would have been diversifying all along, their tax situation might have been different. So that's a story of it could have been avoided if they just would have, unwound things over time versus being forced to do it all at once. And that's very real. That can happen. Companies merge and acquire all the time. And so you've got to be aware that by having all your money, you're risking controlling your taxes when you do that. Do you have a story?
Yeah, that's good. So I've got one for you. And it is, what's interesting about that, Jake, is two companies that are based here in Kansas, or that were based here in Kansas City where we're at. In the time that you and I have worked together, I've seen the same thing happen twice, right? Two companies get bought out, cash buyout, everything gets sold in 1 year. Got the tax issue.
It's happened more than twice, but anyways.
Yeah, that's true. I'm thinking about these two companies, but yeah. So the story I wanted to share was about a client, Jake, that it's not company stock. It's not their company stock, but I think it's very relevant to this conversation. So this person, Jake, took all of their money and put it in one stock about 2 years before they were going to retire. This was before we were working together. And then they tripled or almost quadrupled their money in about 2 years before retirement. And we had a conversation about de-risking the portfolio and how lucky, frankly, they got given the risk that they took in the first place, and didn't want to make any changes to the stock. And the year after they retired, it went down 50%. 50%.
I hate to hear that.
A year later. And what's interesting about that, going back to what we talked about earlier and why this is so important that you have a strategy for it. So I had conversations with this person. They said, if the stock gets back to XYZ price, I'm selling it. And then I'm going to diversify it. Guess what happened? Can you guess? I bet you can guess.
It never got there.
No, it did. It did. And then they didn't want to diversify it.
Really?
Yes.
Oh,
true
wow.
Story. It got back up. It recovered and then some. Didn't want to diversify. It didn't, in my mind, didn't really learn a lesson. FOMO, exactly. And that's why that's someone that you need to understand why the money's important to you, and you need to understand what it's there for, and you need to understand how it's going to fund the rest of your life in retirement, not just trying to catch what's hot and letting your emotions get attached to what's happening on a daily basis. Very dangerous. But the person told me straight up, I should have done this. When it recovers, I'm going to do it. Stock recovered. We had a conversation, not doing it.
I hate to hear that, Cory.
I know.
But it happens all the time,
it's
though.
Real. It's real.
It is real. That's what we're talking about. So it's real. So let me give you a simple framework for our audience on how to do this. And so there is a simple decision making framework that we can walk you through if you want to talk about your RSUs. And so there's 3 kind of categories to this framework. Is number 1, how much of it do you want to keep? And this is for long-term growth. And this is hopefully for people that believe in their company, right? Because if you don't believe in your company and you're keeping it,
well, different story. Yeah.
That's a different story. Exactly. So long-term growth. And again, generally, this is not advice, but generally we want that number under 20% of your retirement. Counting 401ks, IRAs, Roth IRAs, brokerage, anything you have earmarked for retirement. Let's say you've got $2 million, then we want less than 400,000, right? We want to keep it below that, right? So that's for long-term though. That's if you believe you're drinking the company Kool-Aid and you believe in the company. Mm-hmm. So that's decision 1. That's one item of this
what do I want to keep
framework. Yeah. So 2 is just sell it. All right. So let's say you say, Jake, I'm at 25%. Let's sell that 5%. Let's just diversify and let's reduce the risk. Okay. Let's just keep that below 20. And I've done that, Cory. When clients were working and it would drift above 20, would say, all right, let's peel it back. Let's just peel back a little bit. Let's keep it in there because you still believe in the company, but let's make sure we're managing the risk here. And I like that framework a lot, actually. And then the third is strategically converting. So if you do still have stock options, it's cashing them in for cash or selling some of your employee stock purchase plans. So just to talk about those a little bit, Cory, that's typically when you can buy your company stock at a discount. You typically have to hold on to it for X amount of years to be able to fully realize that discount and any taxability of it. So understanding those rules, but again, maybe cashing some of that in as that's vested or you don't have to worry about the holding period with that. So again, all this framework helps you with 3 things: the tax considerations. It helps you take that in consideration. It helps timing with your vesting schedules and blackout periods. And then ultimately it gets your retirement aligned with your financial plan. And that's why I like this framework so much. And you should meet with our financial planners to go over it. Is how much do you want to keep because you believe in the company? How much do you want to sell to diversify and reduce risk and talk about your taxes? And then how much do you need to convert into cash because of stock options, investing schedules, et cetera? What do you think of my framework, Cory?
I like it. And that, you mentioned the blackout periods, Jake. That was something I was thinking about, the ISO and the NSO tax risk, right? There's a lot of different treatment there. Why don't you explain those, Jake? I think you're going to explain that in fewer words than me.
Well, there's incentive stock options and then there's non-qualified options is what Cory's referring to. That's all I wanted to hear. And so they're taxed differently is the key.
Yes.
So
taxed differently. So. Yeah. And I think, actually that was shorter than I would have explained to Jake. And then, tying that into the financial plan, tying it to retirement milestones. I think that's what can give people the sort of the peace and optionality that can come with some of this planning.
Right. Good, Cory. All right. Time for a quick commercial here.
All right.
So again, thank you all for tuning in. Our subscriber count continues to grow. Please share our content, give us a 5-star thumbs up rating. The whole point of Upticks is to enhance financial literacy. And if you like our content, please follow along with both Cory and I on Instagram. My Instagram is Jake_Falcon_CRPC, and Cory's is simply Cory Bittner KC. Also, if you have any feedback for us, we don't allow comments on our YouTube channel for compliance purposes. So you can email Luke simply at luke@falconwealthadvisors.com. Please send him your feedback or any topics that you'd like Cory and I to discuss live here on Upticks. Again, this show is for you, our audience. That's the whole reason we're doing it. So please let Luke know any feedback or topic ideas. All right, Cory, I've got a myth. Remember that show Mythbusters? I asked you this last week.
I do.
Well, we're bringing it back.
Let's hear it.
We're bringing it back. So here's the big myth, Cory. If I sell, it means I'm giving up on my company. And here's the truth, Cory. Selling is not disloyal. It's smart planning. So I was giving you a hard time as a founder. If you said, Jake, I need to sell back some of my shares of Falcon Wealth Advisors to you. I want to put money away for my daughter's college, or Cassie wants a new home and we want to pay cash, or whatever. That's smart planning. It doesn't mean you don't want to work here. It doesn't mean you're not going to work hard for your clients. It's mean you're doing some planning.
Yes.
So the key here for our audience is I want you to think of is I want our audience to shift from the emotional attachment, which I know is not easy, to strategic thinking, right? And recognize, sadly, and most people see this, the big, bad corporate America, that's the way, sadly, they're thinking of you as an employee. You know, your boss may love you and your coworkers may love you, but normally your boss's 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 boss has to manage things on a spreadsheet and numbers. And if your salary is really high, you might be the person that gets tapped on the shoulder to make when they have to make cuts. And so just be aware that they're going to think strategically what's best for the company. When it comes to your retirement, you need to think strategically what's best for you and your family. And that's what we help people do at Falcon Wealth Advisors.
Oh, that's good, Jake. You're not being disloyal. You're being strategic.
Yes, exactly.
That's it.
So Cory, let me know if you want to sell some stock back to me.
Yeah, I'm going to hang on to what I got, Jake.
Good idea. Actually, you want to buy more typically. All right.
That's right.
So
it's probably the other way around. Okay.
That's right. All right. So to recap, Cory, RSUs or restricted stock units, employee stock purchase plans, and stock options, these are awesome, in my opinion, tools. They're not traps. A lot of people think they're cursed by them. They're not. These are smart retirement planning tools. You have choices. How much do you want to keep? How much do you want to sell? And how much do you want to convert? That's all part of the framework that our financial planners can take you through. And the key is aligning that equity up with your retirement goals. Don't treat it like a horse race. Don't have FOMO, right? Don't get emotionally attached. Align it with your retirement plan. So here's my call to action, Cory. If you're unsure, if you're watching this or listening to this and you're unsure of what to do with your company stock, let's talk. Please send a message directly to Luke or to me or Cory, however you want to do it. Let's book a complimentary, confidential consultation, and we will go through this with you. We'll build out a plan, and we'll give you some real specific advice to your situation and see what makes most sense for you. Also, please be sure to subscribe to all of our channels here. Again, Upticks, our newsletter, all those things. Reach out to Luke. He'll make sure you're subscribed to everything. Cory, anything else to add to our call to action here?
What I hear you saying, Jake, is that you need to plan with intention.
That's right. That's my saying.
That's what I hear you saying.
She gives me a hard time with that. Invest with intention, because I say it all the
time.
Who
does, your wife? Is that what you said?
Well, because I was saying it all the time. All the time.
That's good. Keep going.
But I was like, that's good. You're remembering it, Rachel.
That's why you're doing it.
So invest with intention. All right, Cory, we've got a couple more minutes here. I do want to talk. I want to hear about you personally, of course, like always. But I do want to talk. I had somebody send me a message on Instagram, and they wanted to hear about creative ways to spend credit card points. And I don't know if you saw this Wall Street Journal article come through, Cory, but it's a little bit morbid. But I want just to educate our audience in that I didn't know this, or maybe I listened to a podcast. Anyways, credit card points aren't always transferable to your heirs. So a lot of people, I don't do. Do you hoard your credit card points?
I spend them.
At what level do you cash them in?
Usually for travel.
No. How many points do you cash in? Or is that different? Or you just, when you book a trip is when you're cashing them in?
Yeah, typically, but it's probably around 100,000.
Yeah, me too. And we get bonus points and blah, blah, blah. So when I get 100,000 points, I usually cash them in. I'm the same. So, but the point here though, it's just important to remember, Cory, that like, if your credit card is in your name, something happens to you, Cassie actually might not even get them. So that's a reason not to hoard them. You don't want to have millions and millions of points, in my opinion. I don't think there's any benefit there. So if you are worried about that and you don't want to cash them in, then the point of the podcast was to check in with your credit card company. You may be able to list a beneficiary or charity just to understand the rules if you are a hoarder and you're stacking them up. I personally cash in my points. This probably won't surprise people, and I invest them. So my credit card allows my points to go into my brokerage account. So that's all I do is I take them and I invest them into a brokerage account, and then I use them for whatever that brokerage account is earmarked for. So kind of boring. I don't cash them in for travel. I don't cash them in for food or gift cards. So you can do all those things. The key here is you just want to make sure you're getting the most bang for your buck, really. Like,
That's right.
if they're going to pay you 1.5 for travel and 0.5 for the gift cards, then you probably want to use them for travel, right? So just try to make sure you're maximizing them. Make sure you're paying off that credit card every month. Obviously, you want to make sure you're paying off that credit card. And so again, just be aware that they might not be transferable. I'm a big fan of investing them if you have that option. Travel's not a bad one either, Cory, to help pay for some of that trip. Maybe you stay at a nicer hotel. Maybe you fly your 1-year-old daughter first class.
That's right.
She didn't have to pay for a ticket though, did she?
We did.
Why?
Because we had her in her own chair.
You had a 1-year-old in their own seat?
Yeah, her car seat is airplane compliant. So I just popped it down on the airplane, buckled her in, and we were on our way. Versus one of us holding her in our lap the whole flight.
Would they have allowed you to hold her the whole time?
Yep. Yeah, less than 2 years old.
Wow,
we could have avoided it. But the truth is I had credit card points, Jake. That's what paid for that seat.
See, there we go. So I'm glad the person brought this up. All right, good, Cory. As we land today's episode, how about that for the plane analogy? Do you have any personal items you want to share?
I just celebrated another birthday, Jake. My daughter just celebrated her first birthday. We're looking forward to her first birthday party coming up this weekend. I think, Jake, that I'm going to see you and Rachel there. But that's what we've got going on. And Father's Day. A lot going on in June.
Is this your second Father's Day?
Yep. Yeah, last time Daisy was a week old.
Gotcha. Well, I
was still adjusting, but it's different now.
Happy Father's Day, Cory, and happy birthday. June's a big month for you guys. Just like May's a big month for me. It's me, our wedding anniversary for Rachel and I, and Einstein's birthday. So you've got that going on in June. So it's a fun month. I love May because it's a lot of celebrations and fun things. So you're having that. I guess it is Mother's Day and Dog Mom's Day, but I haven't really done anything big for Rachel on that. I was like, I didn't count. You got a dog. I'm not giving you anything for that. So I guess I'm not getting anything for Father's Day. That's all right.
That's good point. See if that boomerang's back.
Yeah, it will. So anyways, well, congrats on all of that. I'm sure it's going to be a fun month for you. And as always, thank you to all of our listeners for tuning in. We hope you have a great week.
Thank you for listening to Upticks. Click the subscribe button to be notified when new episodes become available. Also, be sure to visit our website, falconwealthadvisors.com, and click the Contact Us button if you'd like to meet with Jake and his team.